This is your mortgage rate watch for Wednesday, December the 22nd, and I'm Keith Akada with the Mortgage Reel. So looking at some numbers released this morning, existing home sales for November came at 4.68 million, better than expectation for October's numbers at 4.43 million. Additionally, the inventory of unsold homes declined to a 9.5 month supply over the previous month at a 10.5 month. This is just showing that the sideline buyers are starting to come back into the market. And adding to the fuel of the fire is they're starting to see the prices stabilize in the housing sector, but on the other side, interest rates are starting to move higher. Now, the great example of this, if you took a loan today of $250,000 at a 4% interest rate, just of 3 weeks ago, which we had these rates, you'd have a monthly payment of $1,193.54. Now, taking into what happened in just the last 3 weeks with over the 1% interest spike, that same loan of $250,000 at a 5% rate is now at $1,342.05. That's an increase by $148.51 for the same house that you could have bought within the last 30 days. Now, taking into consideration of the savings, if you take the average homeowner out there or future homeowner looking at spending money on gas on an average of $45 a week at $180 a month, that basic $148.51 savings that's now paying for the same house at the same price, they could have had the savings to pay for something else as far as gas, groceries, anything else that could be relevant to a future homeowner. So these are all things that homeowners are now really starting to consider strongly to make their decisions. And as interest rates start to push higher, then housing sales will also start to push. If you see the bottom of the market in the housing sector, interest rates moving higher, a lot of sideline buyers are going to start coming back in. And this is an obvious good demonstration that right now is a solid time to buy if you're looking at the value between the balance of lowest price, lowest rate. Now, we can't overall say, look at the crystal ball and predict what's going to happen in 2011, but overall, if the economy is showing signs of economic improvement and the job market does start to improve, showing that the GDP did come in today at a 2.6% pace, slightly better than the previous reading at 2.7, which Wall Street anticipated. Overall, they're looking at 2011 for GDP to have a 3.7% growth in order to stunt unemployment. Now, if these numbers do start to pick up and any type of positive sign, again, this is going to add the fuel to the fire to any of the homeowners, future homeowners that are sidelined to come back in the market, because as better and better news comes out, we've clearly demonstrated now that it's going to put pressure on interest rates to move higher. And that's obviously come within the last 3 weeks. Now, with quantitative easing 2, there's a lot of talk about it in the media again. The Feds are going to come out and put that full injection of that stimulus into the economy. Again, keep in mind that's going to put a lot of pressure on interest rates to move higher in the future. So the key thing right now is future homeowners, they're going to start to come back out. And this is the exact same thing that we saw back in 2002 after the dot-com bust. Those future homeowners come back in, and then they start picking up the housing market. So the buy-up market, that's going to be an interesting play to see what's going to happen with those families looking to move because of schooling, education, those key factors for most families out there. So stay tuned. Make sure to follow us on our Facebook fan page. We wanted to put out these key examples today because it's a great indication to show that we are in some type of improvement. Our Facebook fan page is How to Beat the Banks. It's very critical for you to watch that because we're going to be putting out a ton of information. Follow us on Twitter for more breaking news, and we'll be back tomorrow.